Hello and welcome to your Monday Futures Market Outlook for July 5th, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eMiniSource.com, I encourage you to try a 30-day complimentary membership, no credit card required. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. We're now slowly approaching that 80-week moving average and asking the question as to how this plays out. Well, under the circumstances, if this, the first scenario we're looking at is the idea that the market finds its lows here during the summer, somewhere in this range around the 950 to 1,000 area, and subsequently uses that area as a springboard for end of year rally on the upside. And as much as we think that that scenario is possible, the same regards, we also cannot rule out the idea that if we get solidly below that moving average, that this entire rally was nothing but one big corrective wedge formation on the upside that would lead to another breakdown in this market. So we're going to be watching a bigger picture as to how things play out over the next couple months, and in terms of where these lows come in or whether the selling follows through will have a lot of influence on whether we change our bearish bias to a more bullish one. Next here, I want to take a look at a daily chart of that S&P 500, and we were talking about the upper end of the retracement zone, suggesting that S&P could have seen highs even as high as the 1140, 1150 area on the upside. We had a perfect test right into that 1130 area, right in the middle of that blue box where now that 1120, 1140 focal point lays. We were talking last week about this flagging formation and suggesting that any technical breakdowns below this 1070 area would immediately open the window for accelerated selling to not only retest that 1040, 1050 zone, but open the window for even a move as low as this 960 to 1000 area. This morning in the pre-market, we've already seen a move that went down to the 1003 level, so we have already reached some of those minimum downside targets. Nonetheless, we continue to favor the idea that there will be continued selling, but we may first have a market bounce. If we see a market bounce, we'll be looking for it to do solid testing back up into this 1040, 1050 focal point up above, and subsequently, if it can't overcome that area, to roll back down for a solid test into this 960 to 1000 area. Just to review our key points. Our thesis since January 2008 has been that we're in a secular bear market. We're not going to change that thesis until we see where the extent of the selling ends in the current sell cycle. Again, if we find good supports in that 950 to 1000 area over the early summer here and start a counter rally, that could be a springboard to start another significant move higher, in which case we would change to at least a short-term bullish stance on our thesis. Nonetheless, though, if the selling pressure continues lower and does some serious technical damage, we'll maintain our thesis and continue on to see where this market heads lower. Now, even though right now in the short term there's room for a good short-term bounce higher towards even the 1040, 1050 area on the upside, in the bigger picture, the market is now fully in sell mode. So be skeptical about the sustainability of any short-term rally. And even though our targets are about 10 to 50 points lower, understand that if the bulls continue to show a lack of follow-through, these are the market environments from which market crashes start. And even though it's not an easy task to try to predict a market crash, nor is it really something that can be forecasted. Understand this is the type of market environment from which one can actually be created, and so it's important for everyone to maintain a conservative portfolio stance, maintain above average amounts of cash, have a portfolio of hedges in place, and remain skeptical about the sustainability of the rally into the early to mid-summer. When I take a quick look here at the NASDAQ 100, we can see that the NASDAQ also had that technical breakdown below that 1825 area we marked off. At this stage, we've already met some of the first downside targets of the Nasdaq down in this lower zone. We think that if there's a failed rally attempt on the Nasdaq, we could see even the 1600 level hit on the downside once the selling pressure comes back in. But there is always the room for a little bit of a bounce here. Next here, I want to take a look at the US dollar index futures. Essentially, we had a technical breakdown below that 85.50 area on the downside, which has now brought us right into the center of the bottom end of the retracing zone for this entire US dollar correction. This is 83.5 to 84.5 meets all the criteria of a retracement. So we'll be watching whether the dollar index can actually put in some lows in here. If it does, while at the same time as the euro starts to top out a little bit, between that 126, 127 zone on the euro. If we see the topping on the euro and subsequently some good basing on the dollar index here, this could be the springboard from which another US dollar push higher can occur. Next year, I want to take a look at gold futures, and we had a very dramatic $50 or so reversal in gold off of its highs there. We've now got a violation of trend line and a break of that critical 1210 to 1220 focal point below. At this point, there is some technical damage with this reversal, so there is room for gold to continue to correct on the downside. Some of the technical measured moves indicate a corrective pattern could even go as deep as the 1130 to 1180 area on the downside. In the bigger picture, our bullish stance on gold doesn't really change, simply the fact that the gold has to first correct down into the zone before it really at this stage will turn around and begin a new robust rally. The key thing here, as always, is that these one-day reversals in gold in the past have never stuck beyond 1 day. So if we have another solid sell day in gold, it would indicate that the pattern that we've been seeing has changed. So really at this stage, so long as it can dig in and hold here, there's always a chance of a reversal. But if we have any technical breaks below 1200, we're going to be looking for those downside targets. Next, I want to take a look at crude oil futures, and we were talking about this rising wedge in the upside target in the $78 to $80 area. At this point, we're trading a little bit higher this morning. Probably may see even a snapback towards 74, 75 on crude. But in the bigger picture, our downside targets are a retest of that 68 to 70 zone on the downside, and bigger picture targets off of this high could go even as low as the 60 to 66 area on the downside. So we remain skeptical of any short-term bounces in crude. Next year, I want to take a look at the 10-year Treasury notes. We had this little triangle formation develop as a midpoint. Treasury bonds continue to rally. And now that we're getting above the 122 to 122.5 area, this could reopen the window for 10-year Treasury notes to maybe even push as high as the 124 to even 125 area on the upside. What we want to see is a little bit of follow through here. Even if we see a short-term pullback to 121.5 or so on the backside, or even as deep as the 121, it doesn't actually change the outlook. Just simply means it's going to zigzag on the way up. That was your Monday Futures Market Outlook. Thank you for joining me.